Chart showing normal trading. Silver is trading at $84.28. Volume is average, about 340,000 ounces per minute across futures and spot markets. Bid-ask spread is tight at 3 cents. Everything is normal. Highlight, order book depth. The order book shows 4.2 million ounces of buy orders between $84 or $83.50, 3.8 million ounces of sell orders between $84.50, 85 alert deep liquidity down to 82 orders. A healthy liquid market. 2:47 p.m. First strike, screen, red alert, volume spike. At exactly 2:47 p.m., a 34 million ounce sell order hits the market. Not gradually, not in chunks, all at once. Cut to market impact visualization. This single order consumes every buy order from $84.28 down to $82.10, triggers 14,000 stop loss orders, creates panic selling in seconds. Price drops to $82.05 in 38 seconds. 2:48 alert p.m., the cascade, screen, domino effect animation. Now the algorithmic traders kick in. Highlight, algo response patterns. High-frequency trading algorithms are programmed to detect rapid price movement, assume trend continuation, front-run the direction, cut to, cascading sell orders. Within 90 seconds, 47 million additional ounces are sold. Price drops to $78.40. Volatility index spikes 340%. Screen, stop-loss trigger levels. Every dollar down triggers another wave. 82s, 8 million ounces in stops triggered. $80, 12 million ounces triggered. $78, 9 million ounces triggered. 76, 11 million ounces triggered. 2.52 p.m. The capitulation. Cut to maximum panic visualization. 5 minutes in, the market is in full panic mode. Screen, order book destruction. The bid side of the order book has been completely wiped out. There are no buyers between $77 and $74. At 2:52:47 p.m., silver air pockets down to 73 tone intense. Highlight, the gap. From $78.40 to $73.10, a 5:30 drop in less than 1 minute on essentially zero volume. The market had no buyers, none. 2.53 p.m., the recovery attempt. Screen, small bounce graphic. At 2:53 p.m., buyers finally step in. Chart showing bounce to $75.80. The price recovers to $75.80 in 90 seconds, a 270 bounce. Cut to volume analysis. But look at the volume. Only 8.3 million ounces traded on the bounce versus 185 million on the crash. Highlight the significance. This tells you everything. The buying pressure was organic, retail, bargain hunters. The selling pressure was institutional, coordinated, planned. 2:59 p.m., the aftermath. Screen, final settlement data. By 2:59 p.m., exactly 12 minutes after it started, silver settles at $74.20. Cut to damage assessment. Final toll, $11.20. Drop, 14.2% from peak. $8.2 billion in market cap destroyed. 185 million ounces traded 23,487 stop-loss orders, triggered $2.8 billion in long positions liquidated. Screen, comparison to historical flash crashes. This is now the third largest commodity flash crash in history. Oil, May 5th, 2010, 9% in 8 minutes. Gold, April 12th, 2013, 5.4% in 15 minutes silver. Feb 11, 2025, 14.2% in 12 minutes. Cut to host, serious tone. But here's what makes this different from 2010 and 2013. Those crashes happened at low liquidity times. Overnight sessions, holiday trading, thin order books. This happened at 2:47 p.m. on a Tuesday, prime New York trading hours, maximum liquidity, full participation from all global markets. Someone waited for maximum liquidity to launch this attack. Which means this wasn't about triggering a crash in thin markets. This was about sending a message. Let's identify the players who had the capability, motive, and opportunity to execute this trade. Suspect in number 1, algorithmic trading firms. Screen, major HFT firms, Citadel, Virtu, jump trading. Capability. Yes, these firms can execute massive orders in seconds. Motive, profit from volatility, market-making spreads. Evidence, cut to an order analysis. Looking at the order timestamps, 67% of the selling volume came from just 4 originating accounts on the CME. These accounts are registered to 2 proprietary trading firms, 1 market-making firm, 1 hedge fund. Highlight the pattern. But here's what exonerates them. They were responding, not initiating. Screen, timeline of first orders. The first 34 million ounce sell order came from a different account. one registered to an institutional custodian bank. The HFT firms piled on after the initial strike. Cut to verdict. Suspect number 1. Verdict. Accomplices, not masterminds. They amplified the crash, but didn't start it. Suspect number 2. JP Morgan Chase. Screen, JP Morgan logo, trading desk images. Capability, absolutely. JP Morgan is the largest silver derivatives holder globally. Motive, massive short position to defend. Evidence, cut to CFTC data. According to the latest Commitment of Traders report, JP Morgan holds net short positions totaling 87 million ounces of silver futures. Screen calculation. At $84, that position was underwater by approximately $1.4 billion. At $74 after the crash, underwater by only $580 million. Highlight the profit. If JP Morgan triggered this crash and covered 30% of their shorts at the bottom, they made $246 million in 12 minutes. Cut to historical precedent. JP Morgan has been fined repeatedly for precious metals manipulation. 2020, $920 million fined for spoofing gold and silver markets. 2015, admitted to manipulating silver fix. 2012, $150 million settlement for London whale losses. Screen. But here's the problem. JP Morgan's trading is done through COMEX futures primarily. This crash happened simultaneously across COMEX futures, London spot market, LBMA, Shanghai Gold Exchange, multiple ETF arbitrage desks. Cut to expert analysis graphic. For JP Morgan to execute this, they'd need to coordinate across 3 continents, 4 time zones, and multiple regulatory jurisdictions simultaneously. Possible? Yes. Likely? There's a bigger player. Suspect in number 2, verdict. Major beneficiary, likely participant, but probably not the mastermind. Suspect number 3, the Bank for International Settlements, BIS. Screen, BIS building in Basel, Switzerland. Now we're getting somewhere. Cut to BIS background. The Bank for International Settlements is the central bank for central banks. They coordinate global monetary policy, manage gold and silver, derivative positions for central banks, execute large transactions on behalf of sovereign entities, operate outside normal regulatory oversight. Highlight the smoking gun. The BIS publishes quarterly reports on derivatives positions. In their Q4 2024 report, released January 2025, they disclosed, screen, BIS derivatives data, short positions in precious metals derivatives, $847 billion notional counterparties, 14 central banks, average position duration 18 to 24 months. Cut to why this matters. If silver rallied from $84 to 100 plus, these central bank short positions would have faced catastrophic losses, potentially $40-60 billion across all positions. Screen, the motive. Motive, protect central bank positions from a silver squeeze that would have exposed the derivatives fraud, forced physical delivery demands, triggered sovereign debt crisis. Metals backing would be questioned. Cut to the capability. Capability. The BIS can execute through multiple member banks simultaneously. Screen, BIS member bank network, Deutsche Bank, Germany, UBS, Switzerland, Bank of China Citigroup, USA, JP Morgan, USA. By routing orders through multiple banks at once, they can avoid single entity detection, hit multiple markets simultaneously, circumvent position limits, operate in regulatory gray zones. Highlight the February 11th timing. Opportunity. Why February 11th at 2:47 p.m. specifically? Screen, calendar graphic with events. February 12th and 13th, BIS quarterly meeting in Basel. February 14th, G20, finance ministers meeting February 18th. U.S. Federal Reserve monetary policy testimony, cut to with a connection. The crash happened 24 hours before the BIS quarterly meeting, where central bank heads discussed derivatives exposure and systemic risks. Screen, the message. This wasn't just a trade. This was a demonstration of capability delivered to the BIS membership the day before their meeting. The message, we can control silver prices. The squeeze will not be allowed. Cut to, host, revealing the truth. Suspect number 3. Verdict, primary orchestrator. This has BIS fingerprints all over it. The execution network, transition, network diagram visualization. Here's how it likely went down. Screen, multi-node attack diagram. 2:45 p.m. BIS issues coordinated, sell instructions to 5 member banks. 2:46 p.m. Banks pre-position orders across markets, COMEX futures, New York, LBMA spot, London, SGE futures, Shanghai, SLV ETF arbitrage, 2:47 hour p.m. Synchronized execution begins node 1, JP Morgan COMEX, 34M Oz futures. Node 2, Deutsche Bank LBMA, 28 owes it spot. Node 3, Bank of China, SGE, 19 Oz futures. Node 4, UBS arbitrage. Eldenbios ETF selling Node 5, Citi OTC. 8 MIOS derivatives, highlight total coordinated selling. 100 million ounces sold in the first 3 minutes across 5 markets simultaneously. Cut 2, the amplification. The remaining 85 million ounces in the 12-minute period, that was algorithmic traders piling on 47 Oz. Stop loss cascades, 23 Raz. Panic retail selling, 15 MIOS screen. Responsibility breakdown pie chart. BIS coordinated institutional selling, 54%. Algorithmic amplification, 25%. Stop loss cascades, 12%. Retail panic, 8%. Cut to host, direct camera. This was a coordinated central bank operation to defend their short positions and prevent a silver squeeze that would have exposed the paper market fraud. Now let me show you why they're terrified. Transition, deeper conspiracy graphics. The question is, why now? Why did they execute this operation on February 11th, 2025? The screen, 3 trigger events. 3 things happened in the 10 days before the crash that triggered this response. Trigger number 1, the Shanghai delivery crisis. Cut to Shanghai Gold Exchange building. On February 3rd, 2025, something unprecedented happened at the Shanghai Gold Exchange. Screen, SGE delivery data. In one day, 47 million ounces of silver delivery requests were submitted. The SGE only had 31 million ounces in registered inventory. Highlight, the deficit. 16 million ounce shortfall, the largest delivery failure in SGE history. Cut to what they did. The SGE implemented emergency protocols, suspended new delivery requests for 72 hours, required cash settlement for 12 Oz at market price, implemented new restrictions on foreign entity deliveries. Screen, Western media coverage. Western media barely covered this, but in China, this was major news. Display Chinese financial news headlines translated, SGE faces historic silver shortage, physical silver delivery crisis spreads, government restricts metal withdrawals. Cut to why this matters. If the SGE, the world's largest physical silver exchange, can't meet delivery obligations, it exposes the global truth. There's not enough physical silver to back the paper claims. Highlight the timeline.